Okay, we've now reached the Q&A section of the presentation. Let's start with the first question. As volatile as the market has been, what's your best assessment of what we could expect? So this is an interesting question, and I actually prepared a few additional charts as well. So let me bring this over. And so the volatility is defined when we have a 1% move higher or lower in any one day. And last year was about even. So the average days, 1% positive, 1% negative, 66. We had a lot more volatility in 2022. And so far this year, we've had 10 days. So I think, and if I were to interpret this question a little bit, we may feel a lot of volatility. I'll just use myself. I am feeling that there's a lot of energy going on, but we're actually have very, very good results. So the first quarter was tremendous. And this average would, if we were to make it quarterly, it would be 15. So we actually are having, for the beginning of this year, we're actually below the average for volatility. Brian, let me let you weigh in on here. What are your thoughts about volatility and
Yeah.
what we can expect?
No, I agree. I mean, we've been less volatile, but the only thing I would not be surprised if as we get closer to November,
Hmm.
the election, that there will be some volatility
Yeah.
associated with that. I think we've got something planned for later this year to cover a little bit more. We covered some slides last quarter on politics and elections and returns. I think we've got something planned for later this year on that aspect, so it won't go down too far down that place. But while we're a little bit below average, we may get a little bit as the market, as the media stirs up dirt, so to speak. I wouldn't be surprised if there's a little bit of reactionary to that, and then also some folks trying to, depending on what the results are, trying to project and I guess maybe stir things up a little bit. So there may be some more volatility. So we may get closer up to the average as we get closer to this year.
Mhm.
And of course, if we do have some other event, whether it's Israel, Hamas, something else that gets significant, um, I wouldn't be, volatility likewise would probably pick up with some type of a major global event.
Mhm.
Um, but thus far, it's been fairly tamped down.
Mhm. And so to expand on that, yes, to Brian's point, we will be hosting a webinar on September 5th on politics. We're doing this on purpose 2 months before the election to host this event so that we can prepare ourselves for the fall. Okay, next question. Not to turn this into a political discussion, but how can our economy continue while the government lets our deficit grow out of control? So, a couple of thoughts in this area. This document here, is called the Guide to the Markets, and this is one of our sources that we use on a regular basis to do our research. And so, talking about the Fed finances, and actually, maybe I'll just go back to this because this was talking about our Fed finances here. So, our total spending went down over the last 3 months by $400 billion roughly. And so so this was 6.9 trillion last quarter. Um, And to Brian's point, yes, what's bad is that we have $200 billion of just net interest. That's like having a higher mortgage. We have a higher mortgage on our government debt. Having said that, we're borrowing less. So our spending has come down. What's also important about this is to know who holds our bonds. So I think I can quickly get to this. This is fixed income. Who actually is Fed balance sheet, historical aftermath, foreign ownership of US Treasuries 37. So Brian, let you, you're better at this comment than I am, which is to say, and let me cue this up while you're looking at this. One of the things that agitates me is when the news media suggests that when foreign governments own our bonds, that they have some leverage over us, and it's completely not true. Foreign governments own US treasuries and US bonds because they want to, because they pay interest. And that's simply what that is. And so, yes, we run a deficit. Yes, we issue our bonds. And you see on the budget, it costs us roughly 13% to finance that deficit, which is, you know, not nothing, but it's not overwhelming in terms of the interest, the mortgage payment. So Brian, if you would, I know I'm putting you on the spot here, but
No.
if you would please comment on the foreign holders of US treasuries.
Yeah, so on the left there's you can see the percentage of U.S. Treasuries owned by foreigners. So as kind of expanding on Chris's point, you know, first thing is a stable economy, stable government. So that's what attracts foreign governments to U.S. to hold treasuries as far as that stability. As far as the percentage on the looking at the left, we've really not, you know, we've actually gone down since over the last 17, 15 years or so, as far as the percentage of treasuries owned by foreigners. We're now sitting at just roughly 36%. And then out of that 36%, the foreign holders of that, because I know there were some concerns about China holding so much bonds. If you can see the chart on the right, China owns 10% of the 36%, so 3.6%. So it's not like they're in a controlling party. And actually, Japan is now a higher level holder than China is at 14%. And then you see the rest of the kind of the no one country holds, you know, besides Japan and China, you get into other countries. UK's got 9%, Brazil's got 3%. All the others fit into the 47% category over there. So yeah.
Excellent. Thank you. I hope that answered the question. If not, please throw another one in the Q&A and we can definitely dive deeper into this topic. Okay, next question. Regarding the labor force and available jobs, how many of these jobs are actually at an acceptable level of income and jobs that people want? So what's interesting about this is that we've seen another piece about the job. Let me get to that right chart here. The available jobs is we've seen an increase in legal immigration. So what's been happening is legal immigration has actually been on the increase. The illegal immigration, everyone would suggest that that's totally wrong. And no right-minded American would support illegal immigration. Having said that, within the legal immigration, what we're finding, one of the reasons we're not having even more inflation with more and more people working is that, yes, we are finding people who are happy to have these jobs. The other function of our economy, right or wrong, is people make more when they change companies. So because there are more jobs available than even people looking, people are able to change companies and get a step up to, you know, a more of a market rate for their job compared to in the normal environment where there are fewer jobs are typically more scarce. So Brian, let me turn that over to you. What are your thoughts on this question?
So agree with that. So to answer part of the question is we don't really have a breakdown of the the 8.86 million of the profiling of where they fit from a pay rate perspective. So there's more jobs than people looking for jobs. So there may be some mismatch, whether it's profession or income expectation levels or whatever. So that's one of the reasons why, we continue to see the number of job openings there. Um, and really to Chris's point, as far as the immigration, legal immigration, those help fill other lower level income jobs, so they're looking for the opportunity to work in the US. So hopefully we'll see, like to the comment before, we won't turn into a political discussion, but hopefully, regardless of what party comes into mind, that this trend of making people, I guess, as far as the immigration, doing it legally continues to improve, continues to increase, so that we can continue to fill these jobs and then not kind of do a carte blanche job of no immigration whatsoever. So
What was interesting, and I guess I'll also comment on tax revenue. So within the federal budget, what's noticeable, getting to this federal budget here, is our tax revenues. So federal income tax rose meaningfully, corporate income tax rose meaningfully, and we're borrowing less. So these are indications that we're bringing in more revenue, which was also positive in terms of more people working. Okay, hopefully that answers the question. And again, if not, throw more out there in the Q&A. Okay, next question. Under current economic policy, how can the U.S. economy grow with so many regulations? Companies appear to be making money, but less return on their capital invested. That's an interesting, so there is a chart on that. Let me go to JP Morgan and actually comment on earnings growth and profit margins, number 7. So, for example, this is the S&P 500 profit margins. Now, I'm just going to use the S&P 500 as an example. The profit margins are actually quite high. When you look at the last 20 years, profit margins had been in the 6% range. This was one of the major recessions. This was a financial crisis here. But you see the trend growing of the margins improving. And okay, well, here's COVID, and then this trend here. So the fact is that even with margins going down, and this may be another sort of like point that we would get in the news media, is to say, oh, profit margins are going down, profit margins. Well, profit margins are going down from a very healthy number. So I don't know that there are necessarily regulations in terms of that's preventing profit. I guess I thought I would just start by commenting that the profit margins are very healthy. So as we see our news media, and going back to the beginning, almost misrepresenting deliberately so that they get us agitated about profit margins going down, well, they're going down from a very high place. Brian, let me turn that over to you. What are your thoughts on this question?
yeah, I mean, there's really not much more that I can add. I mean, I know there may be some regulations depending on what industries and what areas you're looking at. There may be certain things where they're being a little more cramped as far as profitability and return on capital is concerned. But in general, I don't think there's not been too much policies, I guess, that's seems to be impacting things.
I'm gonna close with this piece here. I want to share with y'all a component on the oil market. So this is page 28 here, and leave you with some data points about U.S. oil production. So this chart is on the oil markets, and here's the U.S. As you can see, from 2022, 2023, and 2024, our U.S. oil production is rising. And let's look at consumption. US oil consumption is growing modestly, but our production is outpacing our consumption. So we are producing 22 million barrels a day. We're consuming 20 million barrels a day. So we are now an oil exporter as a country. And that should give us, some like peace in our mind to know that we have natural resources. We're lucky to have natural resources in our country. And this is the Schwab chart book, and it shows here net imports, net exports. So it's the same chart, but US oil, crude oil, rising production. And then the other piece in terms of natural gas, now this may not be great for some of the oil and gas people in Houston who are selling their natural gas, but when you look at European and US natural gas prices, the prices have come down. So part of the concern going back to this Russia-Ukraine war was Europeans having access to natural gas and the price, given the fact that the supply was going down from Russia. And so this issue has also largely been addressed. The price has gone down. The Europeans have access to plenty of natural gas. So that concern has been addressed. Okay. Transportation is being greatly affected. Everything involves transportation fees. How can earnings be higher than the cost of living? Let me think about this a little bit more. Transportation is being greatly affected. Everything involves transportation fees. I'm not sure about I'm not sure if this is like oil or price of gasoline. How can earnings be higher than the cost of living? Earnings and salaries. So let me see. That goes back to what we were talking about is like price appreciation. Earnings, maybe this is on page 5. This would be something like here. In terms of wage growth. So now, if you're retired, and Brian, I think you've got those numbers down in terms of how Social Security has increased. I guess this is more, okay, so price of gasoline to clarify on the question. I think we have a chart on the price of gasoline in terms of how it's declined. It's increased recently, but where it is over the last 12 months. So for people who are working, wage growth, annualized wage growth is 4.5. Brian, not to put you on the spot, but what are the Social Security numbers? How did those numbers
3.6, 3.2 this going into this year.
And then last year was like 7 or
I think it was 7.2, I believe.
I can't remember the year before. That was 23, 21. It was not low. So Social Security has been increasing. Talking about the price of gasoline, that actually goes back to the inflation chart. So on a 12-month basis, let me make this a little bit bigger. On a 12-month basis, I think gasoline is in here. Gasoline is here. On a 12-month basis, gasoline is gone up by 1.3% over the last 12 months. Now, if we look over the last 3 months, it's definitely risen by more than that. But when you factor this in as of March 2024, it would suggest that actually gasoline prices had come down for a period of time heading into the fall, and gasoline prices have risen as of late, which is also where this inflation is coming in. So inflation has ticked up over the last 3 months. So I think, Pedro, you're hitting the nail on the head, which is we're seeing inflation over the last 3 months. We're seeing gasoline prices rise over the next 3 months. We're seeing auto insurance premiums rise, and that's why interest rates are where they are. and we don't think interest rates are going to be going down over the summer and maybe not at all this year. So all of this energy and information that you're going to get from our news media, because the Federal Reserve is going to meet next week. I'll tell you right now, interest rates are not going down. And then they're going to meet 6 weeks from now. And I'll tell you what, interest rates are not going down. And that's okay. There's nothing wrong with that. The idea that the Fed doesn't know what they're doing, or attack their intellect, is nonsense. They know exactly what they're doing. They're looking at the data. What was interesting was the comment on the news was, I wish they wouldn't talk so much. The Fed chairman used to just be in the background, and now they've become these sort of, not celebrities, but they talk a lot, and people really interpret what they're saying in between these meetings that take place every 6 weeks. Okay, I think.
Yeah, and the only thing on that too, to the question now, looking at the latest CPI data, gas not seasonally adjusted, but gas prices did increase. Looking at February to March by 6.4%, but like to what Chris you pointed out, over the 12-month trend, it was 1.3, so still below. But there may have, what the question may have been more directed at was month over month compared to February. March was the gas increased by 6.3, so there was some, I guess, more sudden visible changes, but over the last year, it's only been 1.3%.
Good. Okay, we have another question. Price to earnings of S&P 500 is trending above historical averages, primarily driven by tech, AI hype stocks. How has diversification of vision-based planning funds helped protect against tech correction and capture upside potential of parts of the market which may be undervalued? Okay, good question. Let me show you a couple of components within that. I prepared. So within our various models, this is our IRA model continuum. And for all of you who have accounts with us, you're going to be receiving this chart and a video explaining these different components. Within each of our models, if I dive into this risk here, you'll be able to see how we are diversified. And I'll just take the aggressive growth model itself so that you can see each component. Okay, so within the aggressive growth model, we are diversified between large cap growth, large cap core, and large cap value. And you see it's almost a third between each of those. So within the Morningstar report itself, so this is the aggressive growth model. If we just had the S&P, or excuse me, like all Vanguard funds, this is where we would be, this square right here. What we have on the bottom is risk or standard deviation, and then we have return on the vertical axis. So within this model, and this is actually within all the models within the continuum, we are taking less risk than the index and a higher return. Now, we do still have exposure to tech. So that's within this Russell Large Cap Growth Fund. So we do own Microsoft, Apple, NVIDIA, Amazon. We do have those holdings, but within the overall holdings themselves, we're also holding, other quality and strategic within the value and growth component. So other sectors of the economy that are expected to do well are finance. So banks have been talked about quite a bit lately, both in the US and internationally. So having those other sectors within the economy are other pieces that we focus on. And I can even show you that within the portfolio snapshot here. I want to find the sectors. So tech is just one of the sectors that we hold. Oh, is that it right here? So tech. technology is right here. So we're actually right in alignment with the benchmark. So we are not necessarily overweighted towards tech, but the point is valid, which is that there is a lot of overweight, or the price of some of these high tech growth companies has created some valuations that are overinflated.
Yeah. And so, and if you notice there on the aggressive growth model that Chris pointed out, we're really balanced across growth, core, and value. So as part of our regular rebalancing, if there's one area, so say for example, growth, and we've had a lot of go with AI and other technology companies, that by that sector, that area growing faster maybe than some other areas, that allocation may go above 17%. So as part of the natural part of rebalancing, we would sell high and then reallocate those funds to something else that didn't perform quite as well. So we've kind of got some automatic protection. And in addition to the diversification factor that Chris showed, as part of our regular rebalancing routine, we're actually naturally selling high, buying low. And likewise, if there was some tech correction, tech collapse, and say, for example, the growth area fell below 17%, then naturally we would be buying at a lower valuation. So just the natural act of rebalancing helps provide that ballast to the portfolios.
Okay. Good. Next question. Brian touched on it, but what is your investment strategy regarding AI? So within growth, when we do our research, we're filtering for large cap growth in general. So getting to this fund here, this Russell 2000, this is the US growth fund. When we're doing our research every 3 months, and we just completed our research last week, we dedicated an entire week to the research itself. We filter for the components that I reviewed earlier, which is risk and return. So we don't want to take a high risk, high return fund, because typically in that quadrant of investments, they go straight down. So, or over time, I should say. So what you're finding here is that when we're making our selections of the particular fund itself, we're reviewing the positions. So NVIDIA is a perfect example where we hold 9% of NVIDIA. NVIDIA has done fantastic over the last 12 months. Over the last 20 days, it's not done so great. So, it's just one of those things where it's done so fantastic and it's given up some of its gains.
And just to clarify, the 9% within that growth, large cap.
9% of the 17. Yeah.
Yes. Mm-hmm.
So Amazon, Meta, Google, Eli Lilly. So we don't have, and I hope I'm answering the question, we are not, moving towards let's not add an AI component. We're aware of it. I mean, tech has done fantastic. This large cap growth fund has done. I mean, if you look at the overall total return, you look at 2023, this fund did 45%. So far this year, it's done 11.2. So the funds that we have, and every 3 months we are questioning. I call it. The name is this. We are constructively dissatisfied with every single one of our positions. So when you think about being constructively dissatisfied, we are making sure that each investment within the portfolio is supposed to be there. So this fund itself, we own this fund for a lot of reasons, and I hope I answered that.
Yeah, and we don't make sector bets. I mean, that's really what it comes down to. We don't try to grant. It could be very fruitful, but then again, if you start making sector bets where you're putting all your chips on black or all your chips on red or all your chips on 00, you can win a lot, but you can also lose a lot. And we want to make sure that we keep y'all's financial plan, retirement plans, near-term plans all in mind. We're not stay diversified.
Yeah, exactly. And we're managing the risk. So for example, within the scatter plot, that's why you see this, we have some more aggressive funds, we have some more conservative funds, and when you blend it all together, we have an overall lower risk and higher return relationship here. Okay. I think we're right on time with our presentation here. Thank you all for attending. Please give us feedback. It should take less than 30 seconds. We're always working to improve this event. So please give us your feedback, and we look forward to seeing you next time. Thanks so much. Bye-bye.